Okay, so what are asset classes? Why are they important? And how can it help you improve your finances? Today we'll be talking about what asset classes are, the types of asset classes, what asset diversification is, and the role of each asset in your portfolio. When you're saving money in the bank, you're losing value because of inflation. As of now, the annual inflation rate is 3.7%. That means that if your money is not growing over 3.7%, you're losing money. The average interest rate for an average savings account in the US is 0.46%. Therefore, instead of stashing your cash in a savings account, you must learn how to invest. Part 1. What are asset classes? Asset classes are broad categories of financial instruments or investments that share similar characteristics and behaviors in the financial market. These asset classes are used by investors to diversify their portfolios and manage risk. Different asset classes have distinct risk and return profiles, and they may respond differently in different economic and market conditions. The combination of various asset classes is essential for diversifying your portfolio, managing your risk, and pursuing specific investment objectives. Let's go over the 7 main asset classes. Equities or stocks. These are ownership shares in a company. You're claiming a part of the company's assets and earnings. They have a high potential for high returns and play a key role in providing long-term appreciation on your money. Stocks are considered a higher risk, higher return investment, and some stocks have higher volatility and higher risk compared to other stocks. Some stocks also provide a dividend income, which means that when you invest with that company, the company will pay you some income on a periodic basis because you're investing with that company. I use M1 Finance to invest in stocks for the long term, and what I have the app do is invest for me on autopilot every single Monday into various stocks that I believe in and decide to hold for the long term. I'll have the link in the description below. Next are bonds, which are debt securities issued by governments or corporations. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal. That means that these will provide you a regular interest income and also help you preserve your capital at the same time. Bonds are generally considered lower risk than stocks and are great because they provide a more predictable return profile. Third are cash and cash equivalents. These are highly liquid and low-risk instruments such as treasury bills and money market funds. Cash and cash equivalents provide a safe haven for investors but are usually lower risk and offer lower returns than other asset classes. But especially in times of uncertainty, they aren't a bad place to park your money. So overall, this asset class provides liquidity and stability as they're low risk, highly liquid, and hold a stable relative value compared to other assets. As of now, the 3-month treasury bill rate is at 5.26% compared to 4.23% last year. This is higher than the long-term average of 4.18% and definitely higher than the rates you're getting from your typical Wells Fargo, Chase, or Bank of America savings account. Fourth is real estate. These are physical properties such as residential or commercial real estate that can be bought, sold, or rented for investment purposes. It's an alternative asset class that can both provide you income and capital appreciation. It also provides you portfolio diversification and overall is moderately risky, depending on the type of property and the market cycle. For example, as of now, a lot of companies and firms owning commercial properties are underwater and trying to sell it at a discount because nobody wants to rent office spaces right now. There are also other ways such as house flipping, where you buy a property, add value to it by fixing it up, such as remodeling it or adding a new roof to it, and then selling it for a higher price. Fifth, commodities. These are physical goods like gold, silver, oil, agricultural products, etc. You can gain exposure to commodities through various means, including futures contracts, commodity-focused stocks, or exchange-traded funds, otherwise known as ETFs. Overall, they can act as a hedge against inflation and provide diversification. They can be volatile depending on the economic conditions. For instance, if there's a shortage of wood or corn, the price of that commodity rises because of supply and demand. The less there is, the more it costs, right? Number 6, alternative investments. This category includes a wide range of non-traditional investments, such as hedge funds, private equity, venture capital, and real assets like infrastructure or timberland. Alternative investments often have a lower correlation with traditional asset classes and can provide diversification. Number 7. Cryptocurrencies. These are digital or virtual currencies that use cryptography for security and operate on decentralized networks. Bitcoin and Ethereum are examples of cryptocurrencies and provide diversification and potential for high returns. These are also considered high-risk investments, as the market is relatively new and constantly evolving. They aren't correlated with traditional asset classes and is volatile because of new regulations in place and many speculators active in the market. Personally, I wouldn't recommend it as a stable form of investment, especially if you don't have a lot of money. By combining these asset classes, investors can create a well-rounded portfolio that seeks to balance risk and return based on their financial goals, risk tolerance, and investment horizon. The unique characteristics of each asset class contribute to the overall risk profile and performance of the portfolio, allowing for a more tailored and diversified investment strategy. Part 2. Why is it important to know the risk and returns of each asset class? Understanding the risk and return characteristics of each asset class is crucial because it helps you make informed decisions that align with your financial goals, risk tolerance, and investment strategy. Here are several reasons why it's important to know the risk and returns of each of the asset classes. Number 1. Optimizing the risk-return trade-off. Different asset classes obviously have varying levels of risk and return. So investors aim to find the optimal balance between risk and return that aligns with their financial objectives. Understanding this risk and return trade-off allows investors to make choices that maximize the potential returns for a given level of risk or minimize the risk for a targeted level of return. 2. Setting realistic expectations. Knowing the historical risk and return of each asset class provides investors with a realistic expectation of what they can anticipate from their investments. It helps set expectations about the potential gains and losses over a given time horizon. Number 3. Portfolio diversification. Investors use knowledge of the risk and return of asset classes to build diversified portfolios. Diversification involves spreading investments across different asset classes to reduce the impact of poor performance on any given instrument or any single investment. This strategy aims to improve the overall risk-adjusted return of that portfolio. Take a look at how many companies Warren Buffett holds. Even if a few companies perform poorly, he's been able to consistently reap profits year after year because of the companies that perform extraordinarily well. 4. Risk tolerance assessment. Understanding the risk associated with different asset classes is crucial for assessing an investor's risk tolerance. Risk tolerance is an investor's ability and willingness to withstand fluctuations in the value of their investment. By aligning investments with risk tolerance, investors are less likely to make emotional decisions while the market is volatile. 5. Long-term planning. Investors often have specific financial goals, such as saving for retirement, education, or a major purchase. Knowing the risk and return characteristics of asset classes allows individuals to construct portfolios that align with their long-term financial objectives. 6. Adapting to market conditions. Economic and market conditions can change over time. Knowledge of the risk and return of asset classes enables investors to adapt their portfolios to changing market dynamics. For example, in times of economic uncertainty, investors may seek to allocate more funds to assets traditionally considered lower risk, such as bonds or T-bills. 7. Avoiding overconcentration. Overconcentration is the opposite of diversification, and it can increase vulnerability to adverse events that impact specific industries or sectors. Understanding the risk and return of asset classes is fundamental in making informed decisions, constructing a diversified portfolio, and achieving long-term financial objectives while managing risk appropriately. Part 3. Why is asset diversification important? Asset diversification is a fundamental principle in investment and finance strategy, and its importance lies in managing risk and improving the potential for stable, long-term returns. Here are some key reasons why asset diversification is important with your finances. 1. Risk mitigation. Different asset classes have different risk and return profiles. By diversifying across various asset classes, such as stocks, bonds, real estate, Investors can reduce the impact of poor performance in any single investment on the overall portfolio. 2. Stability in the volatile markets. Financial markets can be unpredictable and subject to volatility. Diversification helps smooth out the ups and downs in a portfolio's value, providing a more stable and consistent return over time. This is especially important during economic downturns or periods of market turbulence. 3. Enhanced risk-adjusted returns. Diversification allows investors to optimize the risk-return trade-off. While it may not eliminate all risk, it can improve the risk-adjusted return of a portfolio. A well-diversified portfolio seeks to maximize returns for a given level of risk or minimize risk for a targeted level of return. 4. Capital preservation. Diversification can help protect capital by reducing the impact of severe losses in any single investment. This is crucial for investors who prioritize preserving their initial capital while still seeking reasonable returns. 5. Adaptability to market conditions. Different asset classes may perform well under different economic conditions. For example, during economic expansions, stock may outperform, while bonds or gold may provide a hedge during economic downturns. Diversification allows a portfolio to adapt to changing market conditions. 6. Reduce vulnerability to specific events. Concentrating investments in a single stock or sector makes a portfolio vulnerable to company-specific or sector-specific risks. Diversifying across various industries and sectors can help reduce the impact of adverse events that affect specific companies or industries. 7. Behavioral benefits. Diversifying can also help investors avoid emotional decision-making. During periods of market stress, having a diversified portfolio can provide a sense of security, potentially preventing investors from making impulsive decisions based on short-term market movements. It's important to note that while diversification can help manage risk, it does not guarantee profits or eliminate the possibility of losses. Also, the degree of diversification depends on an individual's risk, investment goals, and time horizon. So to summarize, asset classes are broad categories of financial instruments or investments that share similar characteristics or behavior in the financial market. They include equities or stocks, fixed income or bonds, cash and cash equivalents, real estate, commodities, alternative investments, and cryptocurrencies. Investors use these classes in diversifying their portfolios, each with its distinct risk and return profiles, optimizing the risk and return trade-off, setting realistic expectations, strategically investing, avoiding overconcentration, adapting to changing market conditions, and investing for the long term. I'd like to know which of the asset classes you're currently investing, or which of the asset classes you plan on investing into the future. Comment that down below, and make sure to check the link in the description for the app that helps you invest long-term with stocks. Make sure to like and subscribe, and I'll see y'all in the next one.